Welcome back. Metro Brands is another one which is up 4%. So a lot of these holiday stocks as well as consumption stocks doing fairly well. Good news, flight operations have resumed at Srinagar Airport, so that does well for all the travel and tourism stocks too. Speaking about travel and tourism, Chalet Hotels reported a very good set of fourth quarter numbers in line with how the industry has performed so far as well, a tad better if you must. The revenue and margin came in fairly strong. Average room rates increased by 21% as well. So to discuss this and the demand picture going forward, we have Sanjay Sethi, who's the MD and CEO of Chalet Hotels, joining in. Thanks a lot, Sanjay, for joining in. Always a pleasure speaking with you. Good end to the fourth quarter, or rather good end to the financial year. Question is, what are you targeting for this year when it comes to revenue? And if you could break that up for us in terms of, increased occupancy, increased rates, and at the same time, increased revenue coming in from your real estate vertical or annuity business, which is margin accretive.
Sure. Mangalam, always a pleasure back being on the channel with you. Thank you for having me. Look, we've had a very strong quarter four. It's been record-breaking on all parameters. And it's in line with what we've been saying, that the industry continues to have tailwinds for the foreseeable future. And on the macro front, I see 3 to 4 years continue to be very strong, where demand will outpace supply. And therefore, we'll see some small occupancy improvements in stabilized hotels. But more importantly, we should see rate improvements going forward. The current situation in the last couple of weeks obviously had us a lot concerned. We took contingency steps to freeze costs and watch monitor the situation very closely. We also worked with the local authorities in helping in whatever way we could. It's always nation first for our team at Chalet, and we sort of followed that. Going forward, I'm hoping with the way things are, and I cannot confirm that, but if things continue to settle down from here onwards, we believe business for June will be back to full pace. In May, we've lost some business. So whilst April did well, May we've had hit some losses and cancellations. So far, June looks strong. Having said that, and having said that May we saw some cancellations, we've still grown at 12% over the May of last year. So the growth is still on. And we believe that we will see double-digit growth on existing hotels. And as we add new hotels, the inorganic growth will start kicking in very sharply. The office assets are moving into fruition and leasing activity very quickly. We've had an exit rate of 21 odd crores in the month of March. And I think this month onwards, we'll probably be at 25 crores, which means 300 crores of rentals from the office assets and around 95% flow through from those rentals. So they will assist us. Hospitality continues to be the largest part of our business, which we now have in 2 segments, which is leisure as well as business hotels.
Okay. Mr. Sethi, I just wanted to touch a little more upon the cancellations that you faced in the month of May and the impact that you've seen. Can you quantify that for us? See the percentage of cancellations and what might the impact be specifically in possibly properties that you have up north?
Sure. So the leisure hotels obviously saw cancellations of MICE movement because it was very uncertain last week. We hope that some of them will come back because they've not all canceled, they've actually pushed back the dates. So we expect them to come back, and maybe subject to availability, it'll help us grow the business going forward from this what we lost here. As I said, we are still, despite what's happened in the last 2 weeks, as of 11th of as of May, 12th of May, we are 12% over last year for the first 12 days of May. We are still shy of our targets by about 6 to 9%, but it isn't by any imagination a massive hit.
Got it. Just from a growth standpoint, I remember, Mr. Sethi, you have been earlier saying that FY26 is a year where a lot of your assets will come on stream. FY27 is where one should see growth. So I'm just plugging in some of the numbers. You have around 3,300 keys right now with about 1,250 under development. So that's an immediate 30% push through when it comes to capacity. Even your, annuity assets should increase by about 10 to 20% over and above what they're doing right now. And FY25, you ended with revenues of close to 1,700 crores. Assuming you do 2,000 crores, basis what you've been talking about in FY26, are we looking at numbers close to 2,500 crores on the top line with 40% plus margins in FY27? Would there be a fair estimate?
So we don't give forward-looking numbers, but I would say your numbers are not too far off. We have our own assessment of the situation. We believe we'll do better than that.
Right. So 2,500 crore is achievable by FY27 with 40% plus margins. Also in your balance sheet.
We have delivered 46, 47% margins now. So it's not just 40% margin, it's north of 45%. And as office assets mature, the margin will also improve.
I was just being a little conservative out there, given the sort of operations that would come by and, all those assets requiring some of the investments, etc. But 45, 46% is what the street will take. What about your balance sheet? You had delivered a little bit because of the funds that you raised via QIP, sub 2,000 crores. But then thereafter, you made an acquisition of Western Himalayas, which added about 500 crores to your debt. So where does that picture stand at right now in terms of net debt? And what's your deleveraging plan?
Yeah, net debt is a little shy of 2,000 crores. We've taken enabling resolutions for raising 1,000 crores sometime in future, but those are only enabling resolutions to keep our gunpowder dry for further growth activity. Most of the pipeline that we've announced, in fact, almost all of it, will be serviced by internal cash flows. But if we get some opportunities going forward, we'd like to keep the balance sheet in a situation where we can actually activate some of those. Our overall goal is to go north of 5,000 rooms in between pipeline and operating hotels. Okay. And we expect that to get through that in the next 4 to 5 quarters.
All right. You do have 2 properties, one in your Western Hyderabad as well as your Khandala property. When exactly does that start reflecting in terms of your P&L?
Western Hyderabad is already operating. It is Western Himalayas, which we acquired on I think around 10th or 12th of February. So it is reflected for about 40 plus days in the last financial year. But this is a ramp-up property. The occupancies are in ramp-up phase. The average room rates on that property are very high. They're currently hovering around 27,000, 28,000. Occupancies at about 43 to 45%, and we believe they will stabilize at about 60% going forward. On the Duke's Retreat in Khandala, we have 73 rooms operational, but we didn't have a banquet hall ready. That's getting ready by end of this month. And with that and the expansion on rooms to 145, we expect this property to really kick in from October of this year.
All right.
All right, Mr. Sethi, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Chalet Hotels. That stock is down around 0.5%. Yes, they did see some amount of impact on account of the geopolitical tensions in the past week odd, but nonetheless, on a year-on-year basis, the month of May is still up around 12%. So that's important to note. We need to take a short break, but on the other side, we'll get you more on the market. Stay tuned.
Network 18 decimates Times Internet with over 6 times more unique users on social media. Network 18, the undisputed leader of news networks, way ahead of the times.